Hello friends, in our previous lecture we have completed 5th chapter of statistics, that was for semester 2, and today we are going to start again a new chapter in account, that is also for semester 2, 11th chapter, that is last chapter of this first part, bank reconciliation statement, very important chapter. Now friends, what does this bank reconciliation statement means? Or if I am speaking, what does the term reconciliation means? So in account or in accounting sense, reconciliation means to recheck or to verify. Suppose there are two friends, they are going outside for a picnic. Now as you know, they will incur so much of expense, so both are keeping the accounts. Account means I am telling hisab. Suppose the total expense as per friend A is 500 rupees, including both A and B. There are two friends A and B. And the expense as per friend B is 510. Now, there is a difference of 10 rupees in the accounts of Mr. A and Mr. B. So what they will do normally, what we will do normally, if we are friends, we will check which are the expense we have done and we will verify once again with each other. Now according to friend A, there is 10 rupees less, and according to friend B, there is 10 rupees more. So if A has to reconcile according to B, A have to add 10 rupees expense, so he will come to the answer 510. And in the opposite sense, if we are checking the accounts as per friend B, then friend B has written rupees 510. So if he wants the same amount as A, he will subtract 10 rupees and he will come to the point. So if we are reconciling or re-verifying according to A, we have to add 10 rupees, or according to B, we have to subtract 10 rupees, but not as per both. Any of one, whether A or whether B. So that process, we can say it as reconciliation. Now reconciliation in accountancy means similar that thing. Now the name is bank reconciliation statement. Here we are reconciling or re-verifying the bank balance. And why it is only to be reconciled, the reason is that, see friends, we are keeping bank account in our books. Suppose we are the businessman and we are keeping the bank account in our books, that we can prepare as per ledger posting, or we can prepare it as a cash book bank column. Any of the thing we can prepare and we can find out the bank balance. Means as you remember the chapter number 7 cash book, if we are keeping the bank column, then we difference of debit side and credit side is our bank balance or our bank overdraft, or else we can separately prepare a bank account as we have prepared in chapter number 9 ledger posting, and we can find our bank balance or bank overdraft. That is the simple process. Now we have to verify that thing with the bank also. What is the reason behind that? The reason is that, my friends, bank is also preparing a statement for us which is known as passbook. Now we are having cash book, bank is having passbook. That passbook, okay, is given to us only to a customers, but bank is maintaining separate account for each of its account holders. Now one example we will give. That bank balance according to our book is rupees 10,000, and bank balance according to the bank is 10,410 rupees. Now there is a difference of 410 rupees. Now if we are reconciling the cash book and the passbook, we are finding that due to the end of the year, bank is crediting 410 rupees as the interest. Crediting means bank is adding, because interest is our income. Now if we want to reconcile as per cash book to passbook, we have to add 410, because we have to reach till passbook balance. So 10,000 and 410, so difference is of 410. So we will add 410 in the cash book and we will reach to the passbook, that is 410. And if we are doing in the opposite way, if we are taking the passbook as a common and as our base and cash book as the other thing, then from 10,410 we will subtract that 410 because we have to reach to the balance of cash book. So from 10,410 we will subtract 410 rupees and we will reach to 10,000 balance. Now this process we will learn in this chapter, and that is a bank reconciliation statement. So this is a simple introduction about the chapter. Now we are reading what is given in the book. Okay, on page number 263, introduction. Double column or triple column cash book is prepared to record cash and bank transactions. In current scenario, bank services are very important for any trade or business. To pay and to receive, the amount of payments and recovery through bank is also very popular. In modern age of quantum of transactions with bank has also increased and manifold. Manifold means so much of types. For the transactions with or through bank, when a trader opens a bank account, bank gives a passbook or a statement to him. In this passbook, different transactions that have been effected by a trader with the bank are recorded. What is written in passbook? They are explaining. A passbook is a copy of trader's account prepared by the bank in its book. Means it is a summary of all the transactions that trader is doing with the bank, and bank is preparing passbook. We are not preparing. The bank fills up the details in the passbook of customers. If a trader has maintained a bank account in the ledger or has maintained a bank column in the cash book to record the bank transaction, the balance of bank account is worked out at a regular time intervals, that is weekly, fortnightly means 15 days, monthly, etc. Generally, if a trader and the bank, both parties have recorded all the transactions correctly without any mistake, the balance of bank account in the ledger of a trader and the balance as per passbook should tally. Tally means should be equal. Means if we have recorded all the transactions correctly as per the passbook, our difference of bank balance will not come. But because of the errors committed or omission means we have forgot. Omission in recording to the transactions either by a bank or a trader or due to other reasons. If a necessary difference arises between the balance as per bank account and the balance as per passbook, it becomes necessary to find the reasons of such difference. After detection of the reason, a statement prepared to reconcile the balance as per bank account and the as per passbook is known as a bank reconciliation or statement or bank reconciliation. Means after preparing a passbook and a cash book in our book, if both the balances are equal, then normally there are no errors. Why I am telling normally? Because there are some errors due to which our balance will tally, but actually transactions are different. Now, if the balances are not telling and we are re-verifying it, then that process is done through bank reconciliation, and that statement is known as a bank reconciliation statement. Bank reconciliation statement is not an account, but it is only a statement. Please underline that thing. That bank reconciliation statement is not an account, it is a statement. It is used in reconciling the balance as per passbook and the balance as per bank account after finding the causes of explaining such difference. Two things are very important to prepare a bank reconciliation statement. Bank account in the books of trader, that is cash book, and trader's account in the book of bank, that is passbook. Bank account in trader's book is prepared either by separately or as a bank column in cash book, as we have studied earlier in the chapter of cash book. Now let us understand the trader's account in the book of a bank, that is passbook. So now passbook. Passbook means a copy or extract of a trader's account in the books of bank. Underline that thing. What is passbook will be asked in the exam for 1 marks. Passbook means a copy or extract of a trader's account in the books of a bank. A passbook therefore is a book or a statement giving information regarding the transactions recorded by a bank in a trader's account in the ledger maintained by the bank. When a trader opens an account with the bank, a book given by the bank to record the details of that account is known as a passbook. Nowadays, instead of giving passbook, the bank gives a statement at a fixed time intervals with substitutes of passbook. Online statements are also available nowadays. When a trader deposits a cash or check in a bank, or bank collects money on behalf of trader, at that time to give the credit of that amount to the trader, bank records it in the credit column of passbook. Similarly, when a trader withdraws from the bank or draws a check on the bank, or when the bank pays the amount on behalf of trader or recovers some expense or commissions for the trader, it is recorded in the debit column of the passbook. When any amount is increasing the bank balance, bank is crediting but we will debit. Why? I will explain the reason. Now, understand the concepts that we have learned in cash book chapter. The debit side of cash book is known as the receipt side, and the credit side of cash book is known as the payment side. And the relevant rule was debit what comes in, credit what goes out. So if the cash or bank comes in debit, goes out credit. But I said the opposite effect will be given on the bank, in the bank. Why? Because see, you remember the transactions. Bank has credited but we were debiting. Bank were debited but we were crediting. So in the same way they are explaining that same things, that when an amount is increasing the bank balance, bank will credit but we will debit. And in the same way, when due to any reason our bank balance will decrease, bank will debit but we will credit. For a bank, trader's account is a personal account and therefore the rules of personal account applies. As per the rule, the debit the receiver, credit the giver. Bank debits or credits the trader accounts in the passbook. When a trader withdraws cash from the bank, pays for any expense, makes any other payments, a trader becomes the receiver and therefore amount is debited to his account, and when he deposits in the bank or collects any other amounts on behalf of trader, he becomes the giver and he credits his account. In present times, computerized passbook are issued. Now, format of passbook is not required. Directly we are looking about cash book on page number 264. What is a cash book? Traders record all transactions with the bank in bank column of cash book. When trader deposit checks received from the customer with the bank, bank becomes the receiver and bank balance increases. Same way, when the bank collects income of interest or dividend on behalf of trader, bank balance increases, hence bank account is debited by the trader, and when bank becomes a receiver or when the bank balance increases. In the same way, when a trader makes payments to creditor or makes payment of any expenses by check, the bank becomes giver and bank balance decreases and the bank account is credited by the trader. So they are just explaining when to debit and when to credit. Now, very important concept is coming on page number 265, that is bank balance and bank overdraft. Okay. Bank balance in the books of a trader means the excess of total of receipt side over the payment side in the cash book. Thus, bank balance means the remaining amount of total debit side after deducting the total of credit side of a bank column is known as cash book, that is debit balance as per cash book, or bank account is a balance. Whenever we were preparing the cash book, if the total of debit side is more than the credit side, then total of debit side we will write on both the sides and we will subtract the amount of credit side, and the balance that remains on credit side, that is known as our bank balance. And as you know, the balance which remains on credit side is a debit balance and balance which remains on debit side is a credit balance. Balance will be opposite. But the thing to understand is that when the receipts are more than the payments, then that is a bank balance. Similarly, according to the agreement with the bank, a facility to withdraw more amount than the balance is known as an overdraft facility. Why there is an overdraft in the bank? Because we have taken a special service that suppose in our bank account there are 4,000 and we want to withdraw 6,000, then practically it is not possible. But if we have taken the overdraft facility, then 4,000 we are having and bank is giving 6,000, so 2,000 will be our minus balance. That is known as overdraft balance. Here the payment side exceeds the total of receipt side in the bank column of cash book. This difference is known as bank overdraft. Thus bank overdraft means the remaining amount of total of credit side after deducting total of debit side, and it is known as credit balance as per passbook, or it is a bank overdraft. In the same way, where in the cash book credit side is more and balance is on debit side, so that balance is known as a credit balance because it is on debit side, and it is also known as a bank overdraft. We have seen earlier that passbook is a copy of trader's account maintained in the books of bank. It means those transactions which are recorded in the bank account by a trader are recorded. We have seen earlier that a passbook is a copy of trader's account maintained in the book of bank. It means those transactions which are recorded in the bank account by a trader are recorded in opposite effects in passbook. The transactions which we are debiting, bank has to credit, which we are crediting, bank has to debit. Therefore, the bank balance as per passbook means the excess of credit column over debit column, it means a credit balance, and similarly if the total of debit column exceeds, it is known as a debit balance. Now see, in short I will explain. In the cash book, receipt is more than the payment. Balance is on payment side, that is a debit balance. Because the balance is on credit side, it is a bank balance. But for bank it is opposite. Credit balance for bank is bank balance, and debit balance for us is a bank balance. So in short, if we are saying debit balance as per cash book and credit balance as per passbook are bank balance, and in the opposite way, debit balance as per passbook and credit balance as per cash book means bank overdraft. We will write that thing, don't get confused, that things they are explaining in this table. Particulars, bank balance and bank overdraft. For business or for a trader, it is receivable, therefore shows debit balance in the account, and it is payable, shows credit balance. But in simply we want to remember then, bank balance is debit for a trader and credit for a bank. In the same way, bank overdraft is credit for a trader and debit for a bank. Now we will write that thing first. So everyone write the name of chapter. Chapter number 11. Bank reconciliation statement. For that, write a thing first. The effect given in cash book by a trader regarding bank will be opposite effect in the statement that is passbook prepared by bank. What I have written? The effect given in cash book by trader regarding bank will be opposite effect in the statement of passbook regarding prepared by bank. So, what I am telling, if it is debit for us, it will credit for bank. If it is credit for bank, it will be debit for us. So, for that thing, now we are writing. Now we will give the heading and we will write bank balance and bank overdraft identification. Bank balance and bank overdraft identification. How to identify them? Particulars. For trader, First is bank balance. For trader, bank balance is a debit balance, and for bank balance is a credit balance. So for us it is debit, for bank it is credit. In the same way, bank overdraft will be credit balance for us and will be debit balance for bank. So write these things, how we will identify both the balance, that is debit balance and credit balance. So if I am asking you a question from this, debit balance as per passbook, debit balance as per passbook, debit balance as per passbook means bank overdraft. Oh, okay, one more thing also you write here, cash book, here write passbook. So you have to know, if I am asking in the question debit balance as per passbook, then what you will understand, it is a bank overdraft. And if I am telling credit balance as per passbook, then it is a bank balance. In the same way, if I am asking credit balance as per cash book, credit balance as per cash book is overdraft, and if I am asking debit balance as per cash book, then it is a bank balance. Okay, now next. What is given next? Now exactly they are giving the meaning, or they are defining a bank reconciliation statement. In normal circumstances, on page number 265, I am reading meaning of a bank reconciliation statement. In normal circumstances, balance as per cash book and passbook should be same. If at the end of a particular time interval, balance of bank account as per cash book is compared with the balance of passbook, if the difference arises after finding out the reasons thereof, a statement prepared to explain them and to reconcile the balance as per cash book and passbook is known as a bank reconciliation statement. Okay, so which thing? Okay, not underline afterwards. Here it should be noted that even though the bank balance as per cash book and passbook are same, preparation of bank reconciliation statement is necessary because there remains a possibility that details of transaction in both may differ. Suppose if bank balance is 10,000 as per cash book and bank balance is 10,000 as per passbook, then don't think that we don't have to prepare a bank reconciliation statement. Then also we have to prepare. The reason is that balance is the same, but sometimes transactions will be different. Okay? Yes. Here an important point is that bank reconciliation statement is a statement which explains the difference between the two in detail. Because of preparation of bank reconciliation statement, if any accounting errors are committed either by a trader or a bank also comes to the notice, but it does not rectify the error, it shows the difference arising of such errors. Means bank reconciliation statement is used to know the differences. We cannot correct the differences, because if any error is committed by the bank, we cannot correct the passbook by ourselves. We have to request the bank to correct. In the same way, if any error is committed in cash book, then directly we cannot strike it off and we can write the new thing. We have to give the rectification effect for that thing. So they are explaining that bank reconciliation statement is only used to know the differences, but we cannot correct the differences. Now exact definition is coming. Bank reconciliation statement means a statement showing the causes of difference in the balance of a bank as per cash book and as per the passbook for particular time or a particular date. Underline that thing. Now, bank reconciliation statement is prepared by a trader for a certain time or on a date, because of which the difference between the balance of bank as per cash book and balance as per passbook can be found, and the causes can be noticed. A transaction because of which the difference does not arise between bank balance and cash book and passbook is not recorded in reconciliation statement. In other words, if as per the rules of debit and credit the same amount is recorded in both the books, it does not cause the difference. So this was all about the introduction about a bank reconciliation statement. Now tomorrow what we will do? Tomorrow we will learn the formats and the specimens of the transactions, how to record the transactions, how to prepare a bank reconciliation statement, and all that things we will learn tomorrow. This was the introduction and the identification of the balance. The remaining thing we will do tomorrow. So that's all for today. Thank you so much.